Hello, everyone, and thank you for joining us. My name is Andrew Bostian, and I am a partner at the accounting and advisory firm Bloom Shapiro. I prepare business valuations for all matter of purposes with a specialty in exit planning. I'm also a leadership committee member of the Exit Planning Institute's Boston chapter. EPI is committed to providing content to business owners and professionals that serve them to help accelerate the value of their business and provide the best outcomes as they prepare to transition their businesses. EPI is pleased to host this program to provide critical information for business owners who have received funds from the PPP to comply with the loan forgiveness provisions. I am joined by my Bloom Shapiro colleagues, Bill Moore and Chris Hines. Bill Moore is a partner in Bloom's tax department. He oversees and coordinates tax compliance services for many of the firm's corporate clients. Chris Hines is the lead partner of Bloom's transaction advisory practice. Chris's client services activities are focused on providing transaction advisory services to privately owned companies and investment groups with the ability to navigate the transactions from purchase through sale. Gentlemen, please take it away.
Thanks, Andrew. So this is Chris Hines. As Andrew mentioned, I'm a partner in the firm and I lead our transaction advisory group. Most of what our group focuses on is buy side and sell side financial due diligence. And our sweet spot generally is transactions with an enterprise value of about 5 to 100 million. So we're very active in that lower end of the middle market. Thanks for the opportunity to speak today. Our firm has done a lot relative to the CARES Act, specifically the Paycheck Protection Program. Just a little bit of a brief history. The CARES Act was put out in late March, and the goal of it was a stimulus program that everyone had hoped was going to help us get through what we all thought was 8 weeks of COVID-19. The government's intention of the PPP was for companies to use the loan proceeds to really retain their workforce. That was the primary goal. But it also helped pay rent, mortgage interest, and utility expenses for those businesses that were impacted by COVID-19. Just a little bit in terms of the history of some of the guidance that came out. We waited, our firm, so we submitted applications for our clients, helped our clients submit applications in sometime in March. And then we waited, I think through the end of April, we were waiting on the forgiveness guidance. It was supposed to be released on April 27th, and it was going to answer all these questions. On May 15th, we actually got the forgiveness application from the SBA, which gave you a step-by-step guidance on how to complete the forgiveness application. A week later, there were some interim rules that were put out, and they clarified, they specified certain things. So we worked for maybe 2 weeks with clients under those interim final rules and helped clients with the forgiveness application. And then what happened last week was the Senate passed HR 7010, which was the bill that significantly changed things. So we'll talk about that in greater detail. There's a couple of major points in that Senate bill that we'll get into and expand on. And then on the 8th, there was a really important correction that was put out related to the cliff rule, related to the 60% on the payroll, the payroll wage matter. As I mentioned, we helped clients on the front end of this, so we were very active in the application process. It was fluid. We were on the phone all day. The rules were very unclear. So we did our best to work with clients and help them submit their applications. Many of them got funding in round one. Many of them didn't. So they had to wait till round two to get their funding. But one of the things we put together as a firm was we put together what we called the Emergency Relief Task Force. So which was a group of individuals across all of our disciplines. So we have an audit, a tax, and a advisory practice. So we had representation from each of those groups, but then we also had a nice cross-pollination across all of our industry groups. So we're set up and we focus on vertical industry groups. So we really try to get our best and brightest on that committee to think through ways that we could both interpret the rules, send information out to the marketplace, and then most importantly, help our client base. So we consistently are putting on webinars. We have a number of different toolkits on our website that really help clients navigate and are user-friendly so that they can work through the different calculations. We put together many summaries, updates. We have daily web blasts, and we're constantly updating our website. We want to have the latest and greatest content. As a subset of the task force that we put together, we created a PPP technical committee. So there's about 6 or 8 people that are on that committee, and they're the experts on these rules. We stay current. The rules come out at 9 o'clock at night, and by 11 o'clock the next day, we have it summarized and we have an organized response that goes out to our firm. So these are the experts on the front line. But then what we've done is, and we've done this through our transaction advisory team, we actually put together a PPP forgiveness advisory practice. So it's really kind of a part of our transaction advisory group, and we've built it out, and we're able to leverage in the knowledge and expertise that we've built over these last, I'll say, 80 to 90 days. We've got many partners involved in this service line, and what we're doing is we are helping clients with planning so that they can maximize their loan forgiveness, which I think they're all very, very keen on. But then we're also helping clients put together their forgiveness package. So the application is fairly complicated, it's comprehensive. So we're going in and we're helping clients, if they want our help, to build their forgiveness file. So they have all the source documents and all the inputs that go into the forgiveness application. And our team goes in and we check the boxes and we verify and we validate. So when the CFO or the controller or the president of the company has to actually certify that forgiveness application and send it into their bank and then sends it into the SBA, they have a high level of comfort that the information presented in their certifying is accurate and correct. So we've seen a lot of activity in this area, both with existing clients and non-clients. And our goal, again, is just to help our clients as they navigate through these tough times. So with that said, I'm gonna pass this over to Bill Moore, who's one of the members of our PPP technical team, and he can walk you through some of the specifics relative to the rules.
Thanks, Chris. We'll start with the application. I'm not going to get into many details that Chris didn't go through for a couple of reasons. The main one, though, is there's going to be a second application now. The first one is 11 pages. It was somewhat overwhelming, but half of those pages were instructions. So again, it's going to be revised because the covered period now, you can choose 8 weeks or 24 weeks. So they're going to have to make some tweaks to that, significant tweaks. It's almost an overhaul. You will submit that to the lender. We'll go through that process a bit later on, but the main thing to know about the application is there's a couple different forms, and the whole key is to just make sure your payroll is the majority of what your dollars have been spent on. On top of that, the biggest issue is just making sure your full-time equivalents are where they should be. So our toolkits mirror the application, and again, now that it's changing, we have a team that's trying to rebuild it with the extra 16 weeks and the other unique items that came out of the changes. So the application right now, they haven't even sent out a date for when it has to be filed by, but it's certainly going to be extended, and it brings into question a whole host of different issues as to when you're going to put this on your balance sheet for tax purposes versus book purposes. So we can somewhat go through those at the end as well. So the covered period, there was a lot mentioned regarding the covered period, and it really is when the money gets dropped into the bank account. So that's day one. And again, now it was really a crunch with the 8-week covered period, and a lot of clients just weren't going to be able to get there for various reasons. For one, the loan amount was calculated on almost 10 weeks of payroll because it was your monthly payroll times 2.5. So that roughly gave you 10 weeks. And then they gave you 8 weeks to spend it all, but they said you can use, your other non-payroll costs. But still, the original tweak was to try to get a little bit more than 8 weeks of payroll in before they really overhauled it with the 24 weeks. So I can go through that as well, but you basically just need to know that, as Chris mentioned, this was intended to cover the 8-week period where the government really thought that would be the extent of this pandemic. Unfortunately, as we know, it's lasted a lot longer than that, and some industries were hit significantly harder, and some states were hit significantly harder. So they have changed that covered period, and we can get into details a bit more down the line in the presentation, but there certainly are some considerations to make or to think through before you just go with the 24-week period. This alternative payroll covered period, again, this came out with the application in the middle of May, and it really was used to simplify your start date. So instead of having to worry about a cutoff payroll period where you receive the proceeds on May, I don't know, just pick a date, the 10th, and your payroll was on the 15th, and then when you go into the 8th week, you'd end up having an issue too because you'd have cutoff on the back end. They basically said you can line it up, just start with the day after your payroll period ends. There could have been some drawbacks to that. You have to elect it, but it was really for convenience, and it's turned out that there's the ability to get more than 8 weeks of payroll in the 56-day period, which we can go through. I would say the majority of our clients or prospective clients or soon-to-be clients have been very satisfied with the increase to 24 weeks. But as I mentioned earlier, there are a couple of drawbacks. Non-payroll costs. So remember the 75-25, just for sanity's check, that was what had to be spent. So 75% of the loan proceeds were supposed to be used for payroll, and then 25% could be non-payroll. They changed that to 60-40 with the 7010 bill that came out last week. And that, again, was for ease that, you might not be able to use 75% of your payroll, but the non-payroll costs, they needed to be paid during the 24-week forgiveness period or incurred during the 24-week period and paid subsequent to that. So a lot of flexibility there. We know what it includes. It includes your mortgage interest and your rental payments on real and personal property, as well as utilities. The definition for utilities is very vague still. There's some questions on that. Again, now the 40%, it's not a cliff. So if you only end up spending 56% of your loan proceeds on payroll, what came out last week was you're going to get no forgiveness. It didn't make a ton of sense, and they corrected that officially today. I think it was on the 8th. They originally came out and said this was not the intent, but something came out this morning, another interim final rule. So that's my running joke, is we have interim final rules coming out all over the place, not just one set. An important component, and I would say the most complicated component of the application or the whole program, is this FTE. And it's not really the computation. It's just there's so many different dates that you need to calculate your full-time equivalents for. And you can get different results because there's two different ways you can calculate it. The very simple way is if you're a full-time employee salary, you count as 1. If you're anything else, you work 30 hours, 8 hours, you're 0.5. You can choose an alternative method for counting your full-time equivalents, which really is anyone that works less than 40 hours, you divide that by what they work. So if they work 8 hours divided by 40, that's 0.2. If you have a different fraction there, you can certainly get a different result. And that's obviously best explained with an example on the next slide. So the normal way, again, the normal way is to go divided by 40. So if you're hourly 40 or above, you count as 1. You can't have more than 1. If you're 30, you divide that by 40 and you get 0.75, and you think the slide might have an error, but there's a rule that says you round to the nearest 10th. So we don't need to go through all of the different hours listed there, but the point is, depending on how many employees you have, this could certainly result in a different factor for your forgiveness. So make sure you do it both ways. So this is where we get more into questions that were answered that had been outstanding. And then, of course, you get to, with each piece of legislation, unintentionally, there become more questions. So the payroll cost paid or incurred during the 8-week period. And again, when I say 8 weeks, that's now going to be elected. If you don't elect, it's going to be 24 weeks. So you could have payroll costs that were paid or incurred, which means there's the ability to if your payroll period starts on the 10th, but you get or your payroll ends on the 12th, you get the money on the 10th, you pay that payroll on the 12th. So that's during the covered period. So that counts. And then on the back end, they also said, as long as the payroll is incurred, you can actually make a payment outside the 56-day or the 8-week covered period, and it still counts. My just interpretation of that was it was a little more flexible as it became more well known that 8 weeks wasn't going to be enough. And then I think as things started to really slowly open, this 24-week covered period was what came out. For employees who are not performing work but are still on the borrower's payroll, payroll costs are incurred based on the schedule established by the borrower, typically each day that the employee would have performed the work. I mentioned already, there's the ability to get more than 2 months of non-payroll costs included with your forgiveness calculation. Again, now that's 24 weeks. Paid during the covered period or incurred during the covered period and paid on or before the next regular billing date. The one thing they were very clear on, though, is prepayments of mortgage interest is not going to be allowed. Wages paid to furloughed employees count towards forgiveness. Some of these are watered down. These were very important when we were going to have an 8-week covered period only. And these answers came out. So the interim final rules, they're really good at sending out rules late on Fridays, especially on the East Coast. So the application came out on the 15th, and that was a Friday around 7 p.m. And then they said Happy Memorial Day weekend the next Friday and sent out the interim final rules around 10 p.m. for Memorial Day weekend. So these were really important, specifically this bonus or hazard pay. So the maximum amount, just stepping back, was you couldn't pay anyone more than their annualized salary of $100,000. So to break that down, $100,000 is divided by 52 weeks and then multiply the covered period, which was 8 before. So the max was $15,385 that could be used for payroll. And during the covered period, if you just paid someone $10,000, the question was, well, I'm well shy of my total loan proceeds being used. Can I bonus that employee $5,385? And the answer was yes. So this was going to help. My point on will it increase is now the covered period is 24. So the assumption would be that this number of 15,385 goes up to almost, I think it's 46,000, yeah, 154. I have it on the slide. And whether that applies to everyone or just employees, they've started to put some rules in place that are a little less favorable for owner employees, they call them. So that's something that's still out there. But the bottom line is 24 weeks gives you a lot more flexibility. And we think as far as getting full forgiveness or getting majority forgiveness, it makes it easier. But from a record keeping standpoint, certification, time delay, it's certainly more things to kind of calculate and make sure your application is complete. Again, we assume it's 46,154, but we're waiting on authoritative guidance for that. So I kind of segue from interim final rules to this HR 7010, and I actually forget the exact date that this came out, but it was very recent, probably last Friday if we were just to go with the pattern. But again, we've talked about it increases the covered period to 24 weeks. Looks like the cap paid to any employee should go up to 24 weeks divided by 52 instead of 8 divided by 52. We'll wait to hear on that. We talked about when the work counts based on what day would have been performed. Wages paid to furloughed employees, we spoke about that one, and we also spoke about bonuses and hazard pay. One of the most common questions we've received, and I would say we've received it 5 to 10 times daily since this act came out, is what happens if I hit my full payroll or use the full loan in week 11? There's nothing authoritative on if you can apply when you're done, meaning at the end of week 11. But Mnuchin came out last night and said yes. So we're hoping, obviously, to get more authoritative guidance than that. I think that makes sense, because if not, you're going to get 5 million applications potentially all within the same period. But I also see a couple of drawbacks or things if I am the borrower that I really like if they let me apply after 11 weeks. Yeah, so HR 7010, what does this do? It extends the period to replace and restore full-time equivalents and salaries. The June 30th date moves to December 31st. So there's a safe harbor, and it basically says we know that your employee headcount probably went down in the last few months. If you get back to your February 15th pay levels or employee headcount levels, either one, because there's the reduction to forgiveness, if either of those are decreased, then you're not going to have any reduction. So that's really important. Loan forgiveness will not be reduced when there is a loss of full-time equivalents due to requirements established or guidance issued by the Secretary of Health, the CDC, and various other groups. Basically, what this means is if you're a restaurant and they've said you can only open at 25% capacity, well, it's really a bit impractical to presume they're going to be able to keep 100% of their employees on board. So when you get to the employee equivalent testing, and again, they reference several different dates. I think there's 6 or 7 different pay periods that you really need to get your full-time equivalent headcount. It could be that high. There's a safe harbor that you might not need to use, but if you do, it's a lot of dates. Most of them are in the past. One is during the covered period, and then the other is either at June 30th if you keep the 8-week covered period, or December 31st if you decide to, use the 24-week period. You now can defer certain payroll costs. This is important too. Prior to the bill, if you got a PPP loan, you couldn't use that payroll tax deferral, basically the 6.2%. You're allowed to defer that, I believe, through the end of the year, and then you pay back half of it at the end of 2021, and then the other half at the end of 2022. It also changes the loan maturity from 2 years to 5 years. A bit of a blanket statement that I think needs a bit of clarification is that really is for loans that are dropped into people's bank accounts after June 5th. If it's prior to that, you have to work out that agreement with your lender. So some questions that still remain. I think the biggest one in terms of compliance and the clients that have been asking we address, which is, can you apply in the middle of this 24-week period? Did they really mean to increase the wages from $15,385 per employee to $45,153? What are owner employees? My interpretation would be this doesn't include S-Corp owners, but it's definitely gray. And do they also get this increase? What are transportation costs? This is a very common question. So they sent out interim final rules in various different segments. And one was in relation to independent contractors or sole proprietors. And that's the only place we see transportation costs referenced. And then there was some explanation that it's fuel or potentially auto for self-employed individuals. But then we kind of thought to ourselves, does this include other entity types? So we're not really sure on that. Related party rent, also a very common one. We don't see any issue with it based on what's come out. So you should be able to include that in your non-payroll costs. And then the other question is, does it still apply to self-employed as well? We don't really see why it wouldn't. They should go up to the 24 divided by 52, and then it would mathematically guarantee their forgiveness. This is really just the website that we use to update everything. If you want to get on our mailing list or get on our e-blast list, updated toolkits are automatically sent once the email address is on the list. And as Chris had mentioned, we're updating it often. So at this point, I think we want to turn it back over to Andrew, and I think he has some questions he prepared that he wants us to kind of go through. And then after that, if there's any questions that have come in, we'd be glad to kind of go through those as well.
Yeah, thank you, Chris and Bill, for preparing that presentation and taking the time to share your insight. Very, very helpful, as I'm sure we're all moving into the next phase of PPP and more questions come up, and certainly appreciate all your expertise on that. I invite the listeners now, if you have any questions, to please feel free to enter them into the chat box. This has been recorded and will be put on the Boston chapter's section of the website for Exit Planning Institute. So I learned from the presentation that the loan forgiveness application gets sent to the lender. I'm kind of wondering then what happens to it? Does the lender take a look at it, do any vetting, or do they simply forward it on to the SBA for their further review?
Good question. I can take that one, Andrew. I've been speaking to a few different lenders, and this area is still not very clear. I think what's clear is it's certainly going to the lender first. They have 60 days to look at it. What type of review they do is still somewhat up in the air. If they approve it, it goes to the SBA. The SBA then has 90 days. So if you're doing the math, it could be a total of 150 days to hear whether or not you've been granted forgiveness. Another key to this is to make sure you have a complete application. These are going to be coming in by the thousands. So if you miss something on your application, our understanding is the lender will kick it back, and that could restart the 60 days. So for a lot of different reasons, make sure that you're taking your time through the application, that it's sent in complete.
Okay.
Yeah, Andrew, this is Chris, and we have talked to a number of different lenders. And most of them are thinking about, at least right now, is that they're going to rely on the borrower's information and the borrower's representations. So there may be some minimal level of checking, similar to when the original PPP loan application was filed. So the lenders had to check in some payroll data and just do some basic ticking and tying. But I don't know if they're envisioning that they're going to have to do much more than that. That's why we think it's very critical when the forgiveness application is completed and certified that it's done accurately and correctly. That's where we're providing services where we can help.
Okay. Now, let's say the SBA then determines that a business's PPP loan is ineligible for forgiveness. Do borrowers have any recourse? Are they able to appeal that decision by the SBA?
Yeah, they are. Unfortunately, which is the case on some items still, we don't have much clarity as to what that would look like yet, but we do know it's an available option.
Okay. And then, do you know, once you prepare all that documentation and you have what you need, is there any requirements on how long you need to keep the documentation in your files?
Yeah, there is. It's a long time, 6 years. So you might want to frame it, put it somewhere safe, and make sure that if the SBA comes back that you know exactly where it is.
Okay. I do have a question coming in from the audience here, so thank you for that. So the question is, who is the main relationship or service provider helping business owners with the application? Is there, business owners, are they turning to their CPAs, their attorneys, both? Are they doing it in-house? What have you guys heard from your discussions with business owners?
Yeah, so this is Chris. I think it's all of the above. I feel like most of our clients have leaned pretty heavily on us CPAs. I think even sophisticated clients that have sophisticated CFOs are still nervous about this process, and they want backstop because these rules are fluid. They continue to change. There's different interpretations. Some things still aren't clarified. So I think even really good qualified CFOs are asking for help. But in terms of the forgiveness process, there's really two pieces to it. There's the financial component of it and the mechanical calculations and the interpretation of the rules. But then there's also this separate issue, which is a bigger issue, which is demonstration of need. So you saw this a few weeks ago with some of the large public companies, Ruth Chris, the LA Lakers, where they got into some trouble because they really didn't have they couldn't prove that they needed this money, and they were taken away from the pizza shops and some of the retail operations that had basically ceased operations since mid-March. So there's a lot of press around this, and I think they were targeting loans above $2 million. But what we've seen is a number of the law firms start to look at this as an opportunity where if they can help companies with a demonstration of need file, and that's what they're doing now. They're putting all their ducks together and putting it in a package in addition to your forgiveness application with all your underlying support. I think it's a dual approach right now. So we are not, on the finance side, what Bloom Shapiro is focused on. We're not doing any work around around demonstration of need. We're letting them work with their law firms on that, but it is somewhat of a combined effort.
One thought came to mind regarding what a business owner might do, and just wanted to see if you had any insight on whether it's a forgivable expense. But can a borrower accelerate a payment, such as like a business mortgage interest payment, for a forgivable expense so that it falls within the cover period?
No, they're clear on the interest piece that there's no prepayment option. On some of the other non-payroll costs, they're not as clear on it. What they basically say is if it's paid during the covered period, that qualifies. Again, I think this was a bigger issue if you're using the 8-week covered period, because if you're using 24, we hope, given the current situation, that you'll be able to use the majority of your loan for payroll costs.
And how about tax implications of this? Any insight on that?
I think that's a really important one, and I should have addressed that earlier. So originally the thought would be that these would be expenses that were allowed, so there would be no increase to income, but the IRS came out about a month ago and said, sorry, that's not how we're interpreting this. So what they said is if you have expenses that have been forgiven, you're not going to be allowed to take that as a deduction on your tax return. So this is still up in the air. And the difficult part is we have second quarter estimates due. And if you're a flow through entity, those will be due on July 15th. So we have clients that are going through very difficult times and they're looking at their P&Ls, and what are they seeing? They're seeing losses. So a lot of clients are thinking we don't really have to worry about taxes. But just to give an example, if you have a $2 million PPP loan that's forgiven and you have a $500,000 loss, those expenses are all running through your P&L. So essentially a $500,000 loss becomes $1.5 million of income. And then the question, well, it's not really even a question. You'd really have to start paying in July to make sure you have no estimated tax penalty. The second piece of that that's problematic is if you're not aware of it, sometimes entities are just prone to spend the money, and you might get to next April and hopefully everything goes swimmingly and this recovery is just going to keep going up. But if it doesn't, I think it's going to be problematic for some clients, businesses out there to come up with the tax dollars. On that 1.5 million, just to use rough estimates, that could be $600,000 in taxes. So we're in a unique position, and I use unique as a very friendly word, to kind of figure this out in the next month, because we could have clients prepaying when they don't need to, or we could be in a position where next April there's penalties. So I think there'll be something that comes out that really clarifies this in final. But as of now, we really have to go on the assumption that you're not going to be allowed a deduction.
Yeah, and part of me wonders if Congress will get involved the way they had to amend these provisions and kind of extend the coverage period here, or if there's anything further in the pipeline being kicked around in the coming months.
Yeah, I think that's a really good point, or at least some type of leeway on penalties, because I just have a hard time right now having clients pay in that type of money when, quite frankly, there's a good chance that I don't know if it's a good chance, but there's a chance the rule gets changed. And on top of that, cash flow wise, it's probably not going to make sense right now.
Okay.
And it's really not. If you have a client and they have $1 million PPP loan and they think the entire $1 million is forgivable, what this really translates to on a net basis is they're going to lose, as Bill explained, the tax benefit of the $1 million deduction. So on a net basis, if they have an effective tax rate of 30%, they're really going to have a $700,000 forgivable loan, right? Because they're going to pay $300,000 of taxes based on that loss deduction. So I think that's what we're trying to educate our clients on right now, because they're focused on getting $1 million forgiven. But the whipsaw on this is, yeah, okay, the million's forgiven, but you're going to have an offset now that you've got $1 million of lost deductions. So that's really costing you $300,000 in cash flow. On a net basis, it's still good, but you're only at a really effective 70% forgiveness rate.
Okay. Well, I don't have any other questions. I don't see any others coming in from the audience at this moment. But like I said, it is being recorded, so please feel free to give it another listen. It'll be posted on the Boston chapters section of the Exit Planning Institute's website. I know there's a lot of information here, so I encourage you to give it a listen and share with your colleagues and other business owners and whatnot. So I thank you everyone for joining this webinar. Also, if you have any additional questions, please feel free to reach out to Bill Moore or Chris Hines at Bloom Shapiro. And please be sure to check out the Boston chapters section of the website. We have other events coming up that, a lot of great information. Take care, everyone, and have a great day.
Thanks, Andrew.
Thank you.